The public equity side, as you know, is very concentrated on the S&P. By the S&P, 30% is the top 10. They're all in the same, even though technically they're different sectors, all related, basically, technology. Where more and more companies are staying private longer, there's just more of a universe of equities in the private space. So maybe no surprise. But I think one big trend will be, trying to get out of that, just the 60-40 or 70-30 or 30-70 mentality. And because that's still the norm, I had one client recently with a very large amount of money from a traditional, well-known bank, and they had a 60-40. They had no alternatives or profits whatsoever. And in their size of portfolio, they, in my opinion, they should. So I think a trend that we'll see once you have $1 million or more, that trend just continues from maybe near zero to maybe 3 or 4% in alternatives. And maybe that goes up to 10 to 15%, something like that over time.
Welcome to another episode of Trends with Benefits. I am your handsome host, Ed Lopez, and I will be having a conversation with another handsome guy, Eric Mancini, partner and director of investment research at Trap Hagen Investment Advisors. And believe it or not, we're going to be talking about alternative investments, privates, if you will. We've talked about it before, but there's a slightly different angle in which we'll come and tackle this topic today. Think about this. Tracking private investments with public equities. Eric was the inspiration for a new launch by Van Eck that targets these types of companies. So full disclosure there. But I still think it's a pretty interesting story, interesting trend that's really happening in the space over the last couple of years in terms of the interest in private investments and everything alternatives. And with that, Eric, thanks for joining the show.
Thanks for having me.
As I mentioned, alternatives. Maybe we can start there, actually. I'd like to get other people's definitions of that because, you hear alternatives thrown around. It means a lot of things. And more recently, it also means private investments. I don't know. How would you define alternatives? How do you look at this space?
It's a good question because there's a different answer no matter who you ask. The way our firm looks at it and defines it, it's something that does have a predictable, it should have a return to it, obviously. Some the investments do not, but it should have a predictable, logical source of a return. It should not be correlated highly to any traditional asset, whether it be stocks or bonds, and preferably low volatility. And the risk, there's always a risk, obviously, whatever risk investment you take, but the risk has to be generated from something different than the public market, the public stock market, or the public bond market. If an investment meets all those criteria, we generally look at it as an alternative. That said, not all of them that meet that criteria we would invest in, we think are good alternatives. But generally, if it clicks those boxes, we'll consider it an alternative.
Yeah, stocks and bonds generally are the major categories that people are in. Commodities that fit into that space, real estate, and more recently over the last couple of years, private credit and private equity really bubbling up to the fore, perhaps for a few reasons.
Like you mentioned, the commodities and real estate, those are unique because public real estate or REITs, some people would define them, I suppose, as an alternative, but to us, they do act very much like publicly traded stocks, even with a little more vol usually, and to some extent commodities, depending on how you do it. So those, although they are an alternative in some ways, it does not click the boxes for how we look at alternatives.
And I'm just going to jump around for a little bit. We'll come back to this, but you mentioned commodities and how they behave. Do you look at, say, managed futures in the same way?
So managed futures is a good example of, yes, it does click the boxes. However, that one we don't particularly like. We do not have any investments in managed futures currently. And that's more for a different reason, that we also really try to steer away from alternatives that rely on alpha generation or an advisor or a manager constantly, quote unquote, beating the market or finding trends or finding stocks to long or to short or something like that. We'd rather play it, I guess, on a more, I don't want to say easier, but a more beta driven way where, okay, if I invest in private real estate, if I invest in private credit or private equity or infrastructure, there's a source of return to be had, just the beta of it. Where if you're going to manage futures, long short is another alternative, things like that. I don't know if there's actually beta to it. You're really relying on an advisor or manager producing return.
Yeah, you want something an inherent characteristic in that investment.
Exactly.
Yeah.
Yeah,
Okay.
that's right.
I like that. I hadn't thought about it that way, but that makes a lot of sense to me. How do you think advisors' approach to alternatives have evolved over the last decade or so?
So, and that's including us, and that's sort of where we came to this new ETF and new strategy. Is, you rewind the clock a decade ago, and frankly, even now, many advisors and almost all retail had little to no exposure. So I would say the first thing really would be to have some. So whether it was through managed futures, that's been around actually a while in some sort of semi-liquid form, or some other form, it's just making the leap and saying, okay, I want something other than stocks and bonds in the portfolio, which was that's probably the toughest leap to make. If you're in a 730, 70-30, a 60-40, a 30-50, to say, okay, I'm going to disengage from that traditional proven way to manage assets and put something else in the portfolio that requires pretty significant the advisor education in some cases, but also client education. That's the biggest hurdle. So starting really 5-10 years ago, us and other advisors started to just have some alternative allocation. Then once whatever, the advisor picked as a starting point to make that leap into having some material portion into alternatives, then it became, okay, this is working. We found something we like. Maybe it was private equity was the first. Then it's saying, okay, what else makes sense? Maybe we take a little bit out of fixed income, put private credit in there. Maybe we take a little from publicly traded REITs and we look at some private real estate exposure. So first making that leap into private alternatives, then to expand the breadth of it, and then thinking about what vehicles to use. So 10 years ago, it was fairly limited. LPs were the most widely. Those were logistically challenging. You had to be certainly accredited, more likely qualified. So it limited it to 1 or 5 million plus. Over the past 5 years, really, we'll probably get into it, we've seen an explosion, I would say, in interval funds, which makes it a lot more logistically easy and provides some more liquidity, not perfect liquidity, but more liquidity. And then, so over the past decade, it's been introduction of alternatives, expansion of the types of alternatives, and then the expansion of the vehicles used, the ease of use. And if you put all that together, we're just getting a lot more quality products in a more logistically easy and efficient, cost-effective way to offer it to clients. And that's been the trend, and we see it continue.
Yeah, I find it fascinating as a product developer myself. The trend towards some old structures like these closed-end structures, interval funds, to introduce these hot trendy products in terms of privates, for instance. It's kind of cool. What do you think is driving that demand? And it has to be the market, right? Marketplace dynamics, public markets.
It's probably a lot of things for us, and obviously I get to firsthand over the last decade. So I would look at it on two sides. The equity side, because we manage everything to a level of risk. We really don't manage to returns. We manage to a level of risk. So when we look at our equity bucket, we say, okay, what can we do in there to either enhance returns or reduce risk or add diversification to public equities? And there was one stat, I can't, the numbers escape me, but there was one stat of the number of unicorns, unicorns out there, private companies that are $1 billion or more, has just exploded. I think it was something like 35% compounded annual growth rate of the number of unicorns over the past decade or something like that. So there's just a lot more things to invest in the private markets now than there was 10 years ago. At the same time, when you think about it, a ton of liquidity is entering the same 500 public companies, and especially the top 10 that make up, the 33% of the S&P. So part of the impetus into private alternatives is that we still do want equity exposure. Maybe it looks a little pricey to us, the stock market at different times through history. We will diversify our equity exposure into not just, the 500 S&P 500 public companies, but also go into private companies. A lot more of them, a lot more flavors, different levers to pull for different types of returns. and you get that diversification. The other, especially, 3, 4+ years ago, is on the fixed income side. So this was the easiest one, where your, treasuries been yielding, 2.5 or less, even 1.5 occasionally on a 10-year. You got nothing in cash. Investment grade was at 3 or 4. There was the more obvious, I guess, where when you were looking at private credit, private real estate to some extent, insurance-linked securities to some extent, there, at the time of zero interest rates, you could get anywhere maybe from, call it 5 to 8% yields in those areas and still not be subject to stock market risk. So that was probably the biggest impetus for us. And I think that's sort of the major impetus across for all advisors to try to get into this space. And then it's just a matter of finding at what level do you stop at, where now, or, is it a happy balance between stocks, alternatives, and traditional bonds?
Yeah. So how do you do that? How do you find that balance? Do you look at alternatives or, in a bucket in of itself, or do you take it as part of, I don't know, within the equity sleeve, within the bond sleeve, and how much?
Yeah. So the answer is, I guess, sort of yes to both. So we do look at it as its own bucket, but we are cognizant of where it's coming from. So private equity, some private infrastructure, maybe some types of private real estate would be sourced out of primarily private public equity. Then private credit, most private credit, good amount of core private real estate, some lower risk private infrastructure, and ILS gets sourced out of traditional fixed income. The way we look at this is where to source from and where to stop, or when to stop, or how much to allocate to all these things. Really simple. It's just boiling down to, we manage by risk again. So we have a mandate to all our clients to maintain a certain level of risk. Let's say our opinion is, okay, stocks are likely to return in the future 6 to 8% per year over the next decade. If we see, okay, private credit's yielding a net of 9 with lower vol, low correlations, we're going to probably make a effort to, tilt in that direction pretty heavily. Insurance-linked securities, past 3 years, those have yielded, from 10 to 15% and have zero correlation to any financial asset. The risk we're taking there is natural disaster risk, like an insurance company. So there we tilted pretty heavy over there. So we sort of let our opinions of all the returns and risks across the global asset, traditional and private alternatives, dictate, and the liquidity piece comes in as well. So there's a natural liquidity where we can't really cross. Once you get above on a $1 million client, 40% in semi-liquid, that's sort of a ceiling in and of itself. Outside of that, if stocks are down 50%, hopefully they're not, but if they are 40, 50% and valuations are extremely attractive, we would definitely peel off a good amount of alternatives and privates, cycle back into publics, and vice versa.
Do you use certain proxies to model that out for private equity or private debt? I mean, it's harder to get good time series data for some certain private investments now.
Yeah, it depends. The way we're sort of fortunate in the way we invest in almost all of our private investments are through either monthly or daily priced vehicles. So we can model that. Now, obviously, if you're pricing daily private equity or private real estate, obviously you have to be cognizant of how they're valued internally, but we can model it based on those historical prices. So if we have a daily pricing private equity, private real estate, private credit, we could model that in to say, okay, this is what happened with COVID. This is how far down it went. This is what happened when rates went up 3 or 4% to all these different assets. And given that daily pricing model, it does help us significantly. And we're trying to say, okay, our beta, we can't breach the beta of 0.6 or 60% of the volatility of the S&P. When we have that daily priced data, makes it somewhat easier because we're dealing with the same thing on equity funds or bond funds or what else. So we put that in as our risk metric or way to measure risk. And because they're measurable betas, they tend to be low. And you can obviously there's always the argument of, the pricing and the marks and things like that. But we do have the daily pricing we could model that.
What would the benchmark be for some of these things? Would it be a public market index or just?
Yeah, the way we sort of look at it is anything that has replaced our public fixed income. So private credit, insurance and securities, some core real estate, anything that has replaced fixed income, we do comp it to the ag. So if we took out of the ag, then we have to comp to the ag to see if we have added value. And then we add a little addition in terms of a liquidity premium. So we say, okay, the ag, depending on what the alternative is, maybe we add zero point 0.5 on top of it to account for the liquidity. And then if it beats that bench, so be it. That was, we view that as a positive. And the same thing on the equity side. So if we sourced this, private investment from public equity, normally if it's mainly US, we use the S&P. If it's more global, then we use the ACWI, so just public equity indices. And then let's say we have a private equity fund, we say, okay, it has to meet or exceed the ACWI or S&P plus maybe 100 bips to account for the illiquidity. And that's sort of how we're saying, okay, we've added or subtracted value for client.
Got it. And you touched on it a little bit. Maybe you can talk a little bit more about how you provide access to certain of these investments. Is it, say, through fintech platforms or various funds, interval funds, for instance? What more can you say about that?
Yeah, so we do like the ease, the semi-liquid piece of interval funds. So a lot of it is in interval funds, and those basically trade on the buy side, just like a normal mutual fund. So it has a ticker to it. A client would see it just appear along with anything else they hold in the portfolio. The main difference being that it is quarterly sales with a gating mechanism. So we can only sell it once per quarter, 4 times a year. And if generally 5% or more of the fund wants to get out, will be prorated on that sale. So that I would say probably makes up, the interval fund probably makes up, call it 80% of our assets as a firm in the private alternative piece. The remaining 20 would be tender funds, which there's some tender funds they're very similar to interval funds. The only difference being that if they feel it needed, they have the right to say, no, we're not going to honor the 5% liquidity in that quarter. Interval funds by mandate have to honor the 5% liquidity. So we do utilize the interval funds or the ticker tender funds. Those probably make up 90%. On some specific private investments, we really do like. However, they do require paperwork. Maybe they have to be qualified. We have to go through additional hoops per se. But we do like them enough to include them to a limited degree. And those would be private REITs, some other form, either LLCs, a couple LPs, things like that. But those are fairly rare, where we really do like the structure of the interval funds for the ease and the liquidity.
Yeah, great. Now you track ETFs as well, right? In your research, and I mean the industry. Gosh, I've been involved with the industry for quite a while now. It never amazes me and how innovative it can be, and there's all kinds of things happening these days. One of those things is access to privates in various forms. I don't know. How do you look at some of those ETFs that have come to market that provide those sleeves to private equity or various private investments?
Yeah, actually, I looked at those fairly recently just to see. There's two, as you might be referring to or know, in the private credit space. So one was from Bond Blocks. They offer an ETF that is basically, there is a public sleeve in there for liquidity, maybe 15, 20%, I believe, maybe a little more. But then they do have private credit, legitimate private credit in the form of CLOs, so CLO tranched private credit for the majority of the ETF. And I think that works okay. I think that works fairly well. However, the one piece that it doesn't match exactly for what we're looking for private credit is that, yes, just like anything else that's publicly traded, it'll draw down along if there's a stock market dislocation or a hard correction or some panic, that will tend to go down with it. And it does, somewhat affect the correlation piece that we look for. However, generally speaking, if you're looking for private credit, diversified private credit exposure, I think that makes sense. Now, there's another ETF that is, I believe, State Street and Apollo teamed up on that one. That one, that has a relatively small application. I think it's 15% or so to true private credit, the rest being non-true private credit, I believe. And that one seemingly is more just a public, public ETF or semi-public ETF with a little sleeve of private credit in there. And that would have probably limited appeal just because it's mostly public. It's interesting. Another firm, maybe 2-3 months ago, came out with an ETF of catastrophe bonds or the insurance-linked securities. And those cat bonds are sort of liquid or semi-liquid, but it does surprise me that they were able to put it in an ETF. I have been tracking it. So far, it has been tracking okay, but we haven't had it just launched maybe 2 months ago. It's not it is hurricane season, but it's just starting out. I'll be curious to see how it acts when there's actually a disruption or a storm in the water.
Yeah,
but
yeah.
I think ETFs generally are probably not the best vehicle for true alternatives.
We might generally agree, but it's interesting to see that the developments in the space and how people are tackling it and trying to solve that problem. Business development companies, I suppose, are another way of getting access to some of this space and private lenders, things of that sort. And as I kind of teed up at the beginning in the intro and speaking with you, you were an inspiration for a strategy that we recently launched that targeted the equities of some of the managers, these alternative investment managers that offer these types of strategies and funds. Were you looking for something in particular, something that was different than say, actually private equity or a private credit fund?
Yeah, so that's interesting, where obviously it was an organic idea. We've been gradually building our allocation to the true alternative piece, the private credit funds, the private equity funds, the private real estate for over a decade. And we saw the value there in dealing with all these companies, KKR, Blackstone, Brookfield. That is a good business. They have a good business. Not only is it a good business model, it is growing quickly with the advent of technology, regulation changes. The Financial Freedom Act is out there now. I was just on some media. I think BlackRock came out and they're looking to add up to 20% private alternative assets into some of their target date funds by next year. So I think that might be making it way into 401ks possibly.
Mm-hmm.
So, over this last 10 years, just dealing with all these companies, there's two ways we wanted to make money in this trend. One is to invest in the underlying actual alternatives. However, the other was to say, okay, let's own the GPs as well. The KKRs, the Blackstone, the Brookfields, the Ares, the Apollos. And you're right. ETFs have exploded. There's an ETF for everything, I thought, except for one thing. There was no ETF in existence. And I started to look for this maybe 9 months ago that just had a pure play to the GPs or pure alternative asset managers. So that's what we were looking for, is to take that, not the underlying alternative exposure, because this is pure stock exposure, equity exposure, public equity exposure we're taking, but we did want to capitalize on that growth for our clients as well. And yes, that was the inspiration for GPZ, which takes about 20 firms that are essentially pure plays in the alternative private space.
Yeah, fascinating, and that there was still a little bit of white space in the ETF industry. But an interesting thing that I think occurred 2018, 2019, where many of these companies that were publicly traded partnerships made it kind of difficult for tax reasons or whatever to put into an ETF, started to convert to C corps, which made it more feasible.
That's correct. Yes.
And so I think there's a universe of 30 to 40 total names, but only 20 or so, 24 or so that are probably liquid enough to put into an ETF at this point. But yeah, super fascinating. And, we've had interesting discussions about it in the sense of institutions, for instance, even looking at their private investment holdings and wondering, is it worth it? Is it worth the lockups? Are the returns, how do the returns compare? And trying to compare that to creating a mock-up of these public equity of these types of companies and making that kind of judgment call, and say, well, maybe the public equity is just as good.
Yeah, we look at it as two completely different things in terms of portfolio management. So if I'm looking at let's say a balanced type portfolio that traditionally would be 60-40, not anymore with us, but traditional 60-40. Yeah, it's completely two different things as we view it. So if we want to temper volatility, if we want to add uncorrelated assets in there, if we want to be really focused on the risk management piece, if we want to increase cash flows, then yeah, we're going to use the underlying private credit funds, the private real estate funds, the private infrastructure funds. Certainly value there. However, the way we look at the other is okay, there's a stock portion, a public stock portion of our portfolio that will be the risk bucket. We're willing to take risks. We're willing to take on volatility there. We want that growth. We as a firm, we think this trend of growth in this private alternative asset sector continues for 5, 10 years. We're sort of equating it
Hmm.
to, I don't know if it will be as big, but the ETF revolution, started late 90s, early 2000s, and that has grown and it keeps growing, the ETF share of the market from traditional mutual funds. And we think, yeah, maybe we're in, I don't know, the third, fourth inning of private alternatives getting to be a bigger piece of retail and, RIA, family office exposures. And yeah, we want that growth, want growth there. And there's no problem having both exposures. We
That,
do have both. Nothing wrong with that either.
well, that's great. I was going to ask you about your outlook for this space. I mean, you have some well-known names out there, whether it's KKR, which is, I guess, one of the original buyout PE firms. You have Ares, Blue Owl, major players in private credit. And Blue Owl in particular, I guess, got the timing just right. And, founded 10 years ago or so and caught that wave of private credit. And, more recently in the last few months, there have been articles written up. I think one in the Wall Street Journal, perhaps there's too much cash chasing private credit. You still think there's a runway kind of given those dynamics in the space?
Yeah, I do. I think part of it has to do with technological improvements. I think some of it's regulatory, and I think some of it's just organic demand, where for a combination of reasons, it really started with the great financial crisis, tougher regulation on the traditional, legacy type banks. And that sort of really spurred the private credit, if we're looking at private credit specifically. And then over time, yeah, for a combination of many reasons, vehicles, technology, new platforms, ease of use, the regulatory, private credit naturally is just absorbing more of that market share. And yes, am I getting 3 emails in my inbox from a private credit manager every day? Yes, I am getting that. However, I do think that as long as you pick seasoned managers, experienced managers, you understand how they're valuing the underlying credits. And obviously, there's nothing risk free. So you're going to go through periods where private credit does not do well. It's almost been the past, 3, 4, 5 years. It's been incredible, the returns you got on a risk adjusted basis with this. But yeah, I think over the next 2, 3, 5, 7 years, I think there's a lot more runway for private credit and most other private investments. I just think a lot of tailwinds are behind it.
Are there other areas of the market that you are particularly interested in? I mean, even outside private investments, or
There's a couple of new. I'm always looking for new alternative and private investments. There's fewer and fewer that I'm finding, but there are some new ones. I mean, we spoke about, and this is actually the first alternative private investment that we got into in 2013 to any note, and that's the insurance and securities. But I do think it's one of the least well known. It has been around a while. It's been around since the early 90s to some extent, but it's still one of the least well known. If we get a new client into the firm, a lot of them probably at this point have heard of private credit. They understand real estate, probably private equity, but insurance like securities, no idea. So we really do like that because it's the true one that has zero correlation to any financial market. It's only natural disaster risk that you're taking. And going into any particular year, I sort of know basically where the premium levels are, the insurance premium levels are coming in, because they set maybe once a year, occasionally sort of twice a year, but more or less once a year, where I say, okay, this year it's a pretty hard market. Insurance premiums are robust. And you also get the risk-free rate, since these sort of sit waiting for the outcome of a year or two. They sit and you get the risk-free rate on top of it. So I'm saying, okay, if I'm getting 4.5 and the risk-free, insurance premiums adding 8% on top of that, I sort of know what my going in max can be. And then, can't predict the weather, obviously, for the year. But that is very interesting. We do have a relatively large percentage of our portfolio in the insurance securities, anywhere from, call it 6 to 11% of a portfolio now would be the insurance securities. Another part we do, and this is, I guess, a hybrid of traditional and private alternative, would be infrastructure. That is really picking up steam. Obviously, you probably know on the private side, but it has a lot of things going for it. It's an inflation hedge. It's fairly defensive. It's a good cash flow provider for the most part. And it has turned into, utility stocks, anything to do with the grid. Used to be the
Hmm.
most boring, play you can make. Pretty profitable, but boring. Now, I mean, it really is an AI play to a pretty large extent. And we've seen certain, especially unregulated utilities just go, shoot the lights out. But really anything to do with the electrical grid, even natural gas pipelines, those done very well over the past 3, 4, 5 years. We like a lot of infrastructure as well. And then on sort of the cutting edge, I would say, is just starting to look at, and occasionally I'll find a firm offering this. And I notice this as a new trend is, I guess I would call them tax minimization strategies, or tax, I
Hmm.
would say tax arbitrage, but tax minimization strategies, where I had one private infrastructure, well known firm, private infrastructure fund, and it is equity, but they're able to use a combination of structures and ways of investing to basically produce a 12% cash flow yield out infrastructure equity, and it's all tax deferred until
Hmm.
the sale. And that is it's very attractive to a wealthy individual in a high tax bracket. A lot of the private real estate would work in a similar way, where it's tax deferred income, and even some other ones are starting, even that have credit. It's more credit, are starting to come up with ways to have a tax minimization piece to it. So we are obviously, as a CPA firm as well, very
Do
interested
those come with
in.
like different structures or different tax forms, like a K-1 or other, are those 1099 investments? Or
Some of them do, although we try to steer away, frankly, from K1s. I mean, they add complication, they add time, obviously. It's not a deal breaker, but a lot of them even do so without the K1. The depreciation or whatever passes right through to the 1099. So it's no more complicated than anything else. But I'm seeing more and more of those tax strategies, I would say. And another one actually just came probably a couple weeks ago, was similar to reinsurance. So the insurance and securities, but insuring against fixed annuities. So if you have an insurance company that says, okay, we're going to offer a client a 4% annuity, they don't want to take the risk of investing themselves or earn less than the four. So they'd have to pay out of their own pocket. We're going to offload that risk to a reinsurer on the annuity. And now it's on them to produce 4% or more. So that reinsurer, or we would be that investor on that same level there, would go in, say, okay, invest in mostly investment grade type bonds. If we could earn 6%, we know what our outlay is, the four. If we could earn six, we're going to scrape the two. It's so stable, you can apply some leverage to that. And that's really uncorrelated except for absolute default in that case. As long as the cash flow is being produced, it doesn't matter if the value's going down. So there's all different types of things out there we do like, and the amount of effort we put into them basically depends on what the public markets are doing. If stocks we view as on the expensive side, we'll lean more to the alternatives private. If we view public stocks as inexpensive or cheap, we'll lean pretty heavily in those and jettison some of these.
the insurance securities you mentioned, are those, I mean, what type of investor would you allocate those to? Is it a high net worth thing? Is there an accreditation requirement?
That one's actually one of the easiest and
Hmm.
daily liquid. So that one, there is no qualification for, and it is in some cases daily liquid. So there's two main flavors to the insurance securities. One is what are called catastrophe bonds, usually with a 1 or 2 year maturity, and they're literally like bonds. They are bonds. The big difference being the trigger is not a corporate issue or earnings miss or something like that, or corporate default. It would be a natural disaster that hits a certain level of intensity or damage cost, and then it would trigger. It's a binary type of bond for the most part. And those daily liquid, daily pricing, daily liquidity, and those no accreditation, that could be really for almost every one of our clients owns some amount of that because of those reasons. There's also another flavor that's a little more long term. Industry loss warrants, quota shares, basically when you take the literal slice of the reinsurance company's book, whatever they wrote, and then we now own a piece of that. We do require that the insurance company, before we purchase that piece, they retain some on that book. So they're just not writing and it's selling the entire thing. Well, if we want them to have skin in the game too, but that's basically just taking a slice of their book without any of the equity or the management risk. Again, just the nat cat risk. So two flavors, but that's actually one of the easiest and most liquid strategies that we employ in the private health side.
Totally random question, but do you guys use annuities at all? It seems like there's a plethora of different income options for people out there, particularly those going into retirement. Wonder if you guys still use any type of annuity.
We don't, we don't really use annuities. You never say never, but, I would say maybe 98% of the time, we just don't really see the overwhelming use of them. They tend to be more expensive. They tend to maybe lock up for a period of time or forever assets. So no, normally we could find some combination of either public, traditional, or private that could essentially do the same thing, just with less liquidity impairment or, less complication, less fee. So normally we do not use them. Occasionally there's a fixed annuity, so that's so be it. If somebody, has a very large asset pool that, most of it's going to be variable in nature, diversified, goes up and down, and they want some amount, especially if they're single, they want some amount that just be a fixed income that they could rely on no matter what, with an asterisk, I guess, depending on the insurance company, then yeah, that might make sense. But 95% of the time, don't do annuities.
Is there, in your mind, an issue that people are overlooking in their financial planning or investment planning that you think is real important, or perhaps you just hammer home with your own clients?
Oh, that's a good question. It depends on the client, I guess, obviously. I would say one, and this is sort of an odd one in a way, but I think it is important where, yes, there's certainly some clients or prospective clients that come to us and we do have to say, wow, okay, your spending is a little, it's too high. You have to really bring this down, or, your asset base, you have to save more before retirement or something like that. But a lot of times it's actually the opposite, where we have clients that have a tough time shutting off the savings and investment, every possible dime mentality. And maybe they've built up 4, 5, 6, 7, 8 million. They're spending modestly and they're on pace to leave a very large amount of money left over, when they pass. And that's, if that's their goal to leave a large inheritance, so be it, fair enough. But, it's a lot of times saying, you can afford that. You can do this. So oftentimes what we'll do is if we run the initial plan and it's extremely successful, we'll run an alternate, call it, maybe a max spend, we call it. And we say, look, you're spending 100,000 now. If you are happy and you're doing everything you want, great, awesome. But if you feel like you're holding back, if you take one vacation a year and you're flying coach and you want to fly first, or you want to do 3 vacations a year, you could do that. You can spend more money if you want. You worked a long time for this. You saved, you invested, you did great. Enjoy it. So, that's one piece, because really we're here to maximize happiness when you in retirement. Make sure the retirement's sound, obviously.
That's a nice problem to have, right?
Yes, yes. I mean, that is a nice problem to have, but it is, at the same time, it is a problem. And if you don't address that, you have people that are not maximizing their happiness, their retirement happiness, which, to some clients, obviously some clients are in the other bucket, which those are more straightforward. They're more straightforward fixes. Work longer, save more, invest more, spend less. But on the other side, yeah, you want to make sure that, they feel okay in spending if they have the ability to do so.
Awesome. Well, I think you look at a lot of different spaces, and definitely if you're following the ETF space, you're probably exposed to a lot of different trends and asset classes and things of that sort. I know we've talked about private investments and a few other things today, but one question I'd like to ask as we start to kind of wrap up is, what's one long-term trend you see playing out over the next several years, or even that you think that investors are going to have to face? It could be about anything.
Yeah, I mean, there's probably many. I would say one would be, the public equity side, as is very concentrated on the S&P. By the S&P, 30% is the top 10. They're all in the same, even though technically they're different sectors, all related, basically, technology, where more and more companies are staying private longer. There's just more of a universe of equities in the private space. So maybe no surprise. But I think one big trend will be, trying to get out of that, just the 60-40 or 70-30 or 30-70 mentality. And because that's still the norm, I had one client recently with a very large amount of money from a traditional, well-known bank, and they had a 60-40. They had no alternatives or profits whatsoever. And in their size of portfolio, they, in my opinion, they should have. So I think a trend that we'll see, once you have $1 million or more, that trend just continues from maybe near zero to maybe 3 or 4% in alternatives. And maybe that goes up to 10 to 15%, something like that over time. Outside of that large trend, and obviously that's why, we created that ETF to take advantage of that. Outside of that, the other thing I often think about is there's with ETFs, there's been a huge shift away from active management to passive. And if we keep having a good amount of liquidity in the system, you just have this constant passive inflow of funds into the same, mostly the same index, the same companies. And, there's always been okay, is it just that we're going to deal with higher valuations because you just have this money flowing into the same companies constantly? So I think that's something to look at as time progresses to see how concentrated the indices get. Does active make any attempt at a comeback whatsoever? It's tough for us to see it. It's tough for active managers to beat. We as a firm on the public side, we don't have any active funds. So we're part of that. It's just tough to beat. So I'm curious to see what the market makeup is and just how it evolves over the next 5-10 years. If this trend of more ETFs, more passive, a lot of liquidity just funneling into the same 500 stocks, what's that mean in terms of valuations?
Yeah, I could see that. And there's a lot of reason for that. Yeah, the discussion around active is interesting. Right now in the Twitter sphere and elsewhere is like the trend towards active ETFs, even just conversions and just the number of active ETFs out that have come to market. Do you guys use any of those types of structures or buffered products?
I guess it depends. So, it depends how you define active, I suppose. So we do have some ETFs that are not market cap based. They used to be called smart beta, sort of. Now they changed maybe to factor or whatever you want to call them. But we do have a couple ETFs that are based on free cash flow, other fundamental metrics, maybe some momentum, maybe some growth filters, and they rebalance obviously over time. So, and those so far have been successful. And I don't know if I would consider them active per se, but they're not market cap weighted indices either. But we do have some of that. On the buffered side, I've looked at them. The way we view buffered ETFs is and the vast majority are based on usually stock indices. Maybe you have some commodities, maybe you have Bitcoin in there, but mainly stock indices. And as a firm, if we're investing in stock indices with our risk bucket, because when we look at a portfolio top down, we will have said, okay, we covered our risk because we have so much in traditional bonds, so much in alts and privates. We're good. Whatever risk we're taking in a risk bucket, we're good to go. We don't need to reduce risk any further. So if we were to do a buffered equity, it would basically be capping our upside to some extent in exchange, obviously, for a buffer on the downside. But if we're investing in a stock, we want the unlimited upside. We're not that interested in the downside protection. We took care of that off to the side with the traditional bonds or the alt and private. The one ETF, though, there is one that is a covered call strategy on long treasuries. And that is interesting to us. And we have invested in that one because if we invest in bonds, we are not looking for capital appreciation. So we do not view us giving up anything in terms of capital appreciation for bonds. If we're going into bonds, we want the yield of bonds and the non-correlation, hopefully, sometimes. So that's why we're going into long treasuries. And here, because it is fairly volatile, long treasuries, you're getting a good option premium on top. So we have invested in that.
That's interesting. Yeah, I can see that. I just thought about you were talking about trying to get some of your clients to go out and live their life and spend some money. Do you have any good stories? Like what have they done that sounded really cool?
I think the biggest one, I mean, obviously you have the ones that, buy a house, they're buy a shore house, of course, things like that. I mean, the big thing is it's probably travel where you have
Yeah.
some, I had one, and even, I don't know if I'd say travel, but like semi move to other
Hmm.
countries for a period of time. So maybe they Airbnb. I had one client, for instance, that Airbnb'd or Verboed probably had to be 15, 16 countries in a year. And frankly, it wasn't that expensive even. But that was a really cool, a really cool experience for them. They really, really enjoyed the experience. And it did cost some money, but it was well within. They really probably wouldn't have thought of it without, going through the process of the retirement plan and hammering home. It's really about giving them confidence, regardless if they're an ability to do that or not. Retirement planning to me and to our firm is really about giving the client confidence in their plan. They could sleep at night. They don't have to worry about it. We stress
Yeah.
tested it. And if you have that piece of the puzzle where they are confident, they could sleep well at night, they know their retirement set. And then you give them the confidence saying, yeah, you know what? If you want to travel around, you want to go to Antarctica, you want to Airbnb it for 2 months in Costa Rica, that's a nice combination.
Yeah, that's what I think about. I think about traveling for retirement or living in different places for a few months at a time and just being a citizen of the world, if you will.
Yes, yes, that is a nice phrase. I might use that.
Awesome. Awesome. It's funny. This discussion reminds me, it's an old movie. I don't know how old you are, but Brewster's Millions. Do you ever see
I
that?
did. It just came up 2 days ago, actually.
Is that right?
Yes, yeah, that's right.
I don't know how much he had, but he had to spend all this money to get a lot more. And he just kept getting
Great
richer.
movie. Took place right
Yeah.
in Newark. I think it was the Newark Bulls minor league baseball team involved. But yeah, he had a choice of he could take $1 million, I think, or he had 30 days or something to spend
Yeah.
30 million. Nowadays, probably pretty easy to spend 30 million.
Yeah.
But yeah, I don't know if that movie makes sense anymore. But yeah, great movie. But yeah, it is somewhat like that where it's, yeah, and it's good in a way that they were hammered home of savings, investing,
Yeah.
be careful, which is great. That is obviously the most important piece. But yeah, if you did do that successfully, it's equally important to enjoy life and not just sit on money, sitting around. I mean, if that's what you want to do, if you want to sit around. I'm not going to say nothing wrong with that either. But yeah, be happy in retirement if you could do it.
Amen. All right. Quick trend or fad round, if you're ready.
I'm ready. Let's see what you got.
Let's see what we have here. Tokenized funds, trend or fad?
Probably a trend, although it's a very early. I was just talking to a company who's, I guess, one of the first movers in that, and trying to understand just yesterday how they're going to deploy it. I would say, they're still in the very early innings of it. I think they had 11 out there, tokenized funds already out there. And I'm just trying to marry on the tokenized fund or tokenized asset. I'm familiar with crypto tokens and assets. You go to Coinbase, you go to other, Robinhood, and you can trade crypto tokens. Then you go to the, Fidelity or Schwab or whatever, E-Trade, and trade your stocks. And I guess these two rails will sort of marry eventually, where tokenized assets, crypto tokens, Bitcoin, and then stocks can all be traded on the same venue. And I supposedly probably 24/7 and maybe around the world. And you could store it on your own personal thing eventually, your personal wallet. So I do think it's a trend. I think it'll take time to really get those rails going, but I do think it's probably a trend.
AI built model portfolios.
That's a good. That's a good. Actually, I think there was an AI ETF. Maybe it was Goldman. I can't remember, but it was an AI ETF, and this was well before the AI phase came in over the last couple of years. I would have to check. Don't quote me on this one, but I want to say it did not outperform. And I always come back to say, in the 60s and 70s and 80s, you had all these active managers trying to beat one another, and they just can't by default. They're going to cancel each other out. Then you had sort of pseudo AI or algorithms or robo, whatever you want to call them. And you could sort of see it play out in the markets. When there's a headline, it'll trade really quick based on what there's a tweet or something else. And those sort of cancel each other out. So I think if there's, I don't know, 100 AI models out there or portfolios or active AI ETFs or funds, they'll probably cancel each other out. So I'd probably say, what's the opposite? What's the other thing that would trend? Whatever the not
trend. Oh, fad. Yeah.
So I would say maybe that'll be. I think there'll be some that probably makes sense, but for the most part,
when you know everything and your other bot knows everything, then Don't you all do the same thing? I don't know. I don't know.
Efficient market. That is correct. That is correct.
Another tech-oriented one, robo-taxis.
Robotaxis, up until maybe 6 months ago, I probably would have said fad, but now it looks like things are happening here pretty quick. So yeah, I'd probably say trend.
You ever done a Waymo?
I never have, but now I want
Interesting.
to. Now I want to. Next time I'm in a city that does offer them, I would want to try it. And what company benefits the most? There's Uber in there, there's Lyft in there, there's Tesla in there, there's Google in there with Waymo. I don't know. It's tough for me to see how the technology plays out in terms of who's accrues the value. But yeah, I think probably seeing within 3 to 5 years, I think that's a pretty big trend.
And then finally, this is an interesting one because it mixes two things here, but cold plunges before morning emails.
The only time I did anything remotely close to a cold plunge, I guess two. One was in Norway where I was in it, but I was in a sauna first. So I was very hot, jumped into the ocean or whatever there. That was 33 degrees. It was invigorating. I'll give it that. But would I do it every morning? No. So I would say that might be more on the fun side.
Gotcha. That's great. Well, this is awesome. Eric, so thank you so much for your time and perspective. What's the best way for people to learn more about you and Trapphagen and what you guys got cooking?
Yeah, if everybody's interested in learning more about our processes, the private alternative investments, anything we got going, go to our website, www.tfg, as in Trapphagen Financial Group, LLC.com. And that would be the best way. And then we have emails on there that you could contact through there. But yeah, awesome time. Thanks for having me.
I appreciate it. And thank you for tuning in to another episode of Trends with Benefits.